Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. And this is the first one that we have in the year of 2021. And we are starting off this year on a fairly jittery footing. Markets are a little bit are selling off quite a bit here yesterday. Where it looks like we're continuing a bit of that here today. So what we want to help answer the question for many investors is really how do you position for this current market, especially, is this jitteriness just some short-term profit taking, or is this the start of potentially a larger sell-off here? So let's hopefully help you answer some of those questions. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So a little bit of housekeeping before we get started here, just to give you a sense for the events that are currently coming up for 2020. I'm sorry, for this week and early next week. This Thursday, we're going to be doing an education event on understanding debit versus credit spreads. We use a lot of these types of spreads in our trading, both on the daily play as well as on the trade ideas that we send out. So I want to make sure that investors that are trading these types of strategies, selling credit spreads, buying debit spreads, especially with the number of questions that I've been getting recently about these types of spreads, I really wanted to take a little bit of time to break it down, the strategy, make sure you understand it, and best practices for how to manage it. And then on Friday, we're having our next members only members only webinar on thematic investing. This is where we take a longer term view, where we do a little bit more of a deeper dive into a specific industry, take a look at the companies within that industry, and provide some insights into why that industry may be worthwhile to take a look at, and some of the specific companies that we're paying attention to. The last one that we did was on cybersecurity, right before the hack. That was out of sheer luck, great timing on that particular thematic trade. But this week we're talking about electric vehicles. So that's this Friday. That's available only to members. And if you're a member, don't worry, you don't have to do anything. We'll automatically register you for that account, for that webinar. And next Tuesday, I have another special event here. This is available to everyone, where we're going to be doing some trading with Tom Sosnoff and Tastyworks. So many of you love Tom, and I love talking to him and the interviews that I have with him regarding specific strategies. So I'm going to have Tom on, and we're going to discuss some trade ideas using the Tastyworks platform, show you that platform, and show you how we go about evaluating different trades that I'm going to take a look at. And you're going to have an opportunity to submit some symbols and some ideas for us to look at together. So with that, what we're going to cover here today is the major market update. We're going to take a look at where the broader indices are currently sitting, and as well as emerging markets, looking at global markets where they currently sit. And then we'll take a look at rates and commodities. We've seen some pretty major moves here from the dollar and how that's going to affect assets that are priced in dollars, whether you're looking at gold or some of the other assets that we want to take a look at. So we're going to take a look at that. We'll also take a look at sector rotation, where we'll take a look at which sectors are showing some strength right now, which sectors are losing some strength, some strong sectors that are starting to perhaps show some cracks, so that you have a better understanding as to how to position within the sector rotation that we're currently seeing. Looking at the economic numbers, I do want to take a look at manufacturing, because retail sales has been one of the major drivers of the equity market recovery we have seen. But in the early days of the pandemic, we heard companies have supply issues. We're starting to see some of that again in the economic indicators. So this is something that we haven't heard from retailers just yet, but I think this might provide us with a clue of what we will hear from corporate earnings here in Q1, especially from some of the retail and manufacturing names. And then we'll share with you some of our ideas and open this up for Q&A here at the very end. But the primary question that I want to help investors answer is really, are markets starting to roll over here in 2021? Or is this jitteriness that we're starting to see at the beginning of the year just some profit taking, and we're going to see a continuation higher here going forward? So those are the questions that I want to help answer. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you are my charts that I am using to inform my decisions as to my macro views of the broader markets, the different sectors that are on the move, economics, as well as the ideas that I have on my plate. So we'll start off by taking a look at the broad-based indices. We'll take a look at the S&P 500 here. Yesterday's price action was, outsized, if you will, compared to the regular daily moves that we've seen in the S&P 500, down more than 2% intraday, gave back some of those losses here towards the end of the day, and closed just shy of the 21-day moving average here at 368. Looks like we're about to open up another 0.4% lower here, just below that 21-day moving average. But as you can see, historically, especially in these uptrends, when the pullbacks to the 21-day moving average, those have historically corresponded as buying opportunities. And money flow here on the weekly and daily chart so far is still positive, even though it's declining here. So when we look at this on balance, yes, yesterday's move was fairly severe, but most of the moves came from stocks that have done very well here over the past couple of months. So what that leads us to believe it's more of profit taking rather than a start of a correction lower here, at least at the moment. But we are paying attention to quite a few things here, and we will continue to update you if that shifts. But so far, the pullback here is not severe enough, in my opinion, to suggest that we're starting a rotation lower here. And especially if you look at the NASDAQ 100, NASDAQ 100 is still above that highs, the September highs that have put in around 302, holding that level so far multiple times as support, which again leads us to believe that equity markets has room to continue to grow to the upside here if you look at both from a value and a growth perspective. And especially if you look at IWM, I did speak on December 22nd, which is the last session that we had before the break here for the holidays. I spoke about the fact that IWM was getting a little too stretched here. That's exactly what we saw, as a bit of a pullback here, multiple pullbacks here actually. So from my perspective, that's healthy. Now, I think that you might see a little bit more of a consolidation here for IWM before it can continue moving higher, because again, you've had a very strong move here to the upside. You've had no time to breathe. It needs a little bit of time to breathe, and it could have a slightly more severe pullback here as well and consolidate before it can continue moving higher here. So that's my expectation here for small caps. If you look at value versus growth, right now, growth is not outperforming value just yet. So we're still seeing value hold its own, right? IWM holding its gains here to the upside because it's been extremely strong. It has not lost that strength here to growth just yet, but that is one that we're paying attention to very closely to see if growth does come back to life and maybe outperform value. So that is one theme that is very important to pay attention to. But the one that I've been talking about for months has really been EEM, and EEM continues to outperform here. We've talked about EEM since the breakout here. We've talked about the fact that EEM is an exposure to Asia Pacific and the specific sectors of technology, discretionary, and financials sets up well compared to domestic equities, especially if you look at just the contrast of how these countries have handled COVID. On one side, US domestic equities are one of the worst performing in terms of our handling of COVID versus Asia Pacific, one of the best. So when we're starting to see this outperformance continue in the equity markets, EEM outperforming US equities here by a pretty big margin. So this is really where at the moment we expect this emerging market strength to continue. Now, the reason I brought this up here is because we're back near the beginning the 2018 highs, the $52 level. This is our long-term target here for EEM. Now, if we manage to break above 52, this is really where we open up substantial upside here for EEM. So when we're looking at opportunities in equities, we can't help but think that EEM is one of the places that is worth looking at, especially when we're looking for outperformance in global equities. Countries that have had COVID largely under control compared to what we have here in the US is likely going to outperform, especially with ETFs that have a large exposure to specific sectors, and where a lot of the companies have dollar-denominated bonds, which, as the dollar weakens, their ability to pay back their bonds actually increases. These are all tailwinds here for EEM. That's why I continue to like this, the emerging market story here in 2021 going into this year. When we look at the VIX, we saw a pretty big move here to the upside yesterday. We've talked about the new volatility regime of volatility going forward, where it's likely going to be somewhere between, this 18 to $28, 28% level here on the VIX. We just tagged that 28% range here yesterday. So from my perspective, I do believe this is the upper bound of the range here for VIX. It doesn't mean that we can't have intraday spikes or short spikes above 28. It will happen. But likely 28 is going to be the longer term end of the higher end of the range here. So a potential opportunity to sell puts, sell put credit spreads on stocks that you think are strong, that you think are going to move higher from here are from an options perspective, the right strategy to take, or the optimal strategy to take. When we look at the dollar, this is another one that we've also been talking about for months now, is the weakness of the dollar. That's why we went long EEM. That's why we went long FCX. That's why we went short UUP on options action that one day that we did all 3 trades. Now we are just shy of this $88 target here, which is the lows from at the beginning of 2018, end of 2017. So this was our target here to the downside when we broke 92 was 88. So we're just shy of that $88 level here now. And the one thing I will point out here is that if we break below 88, there's substantial downside here down to the 80 level. Now, this has major ramifications for assets priced in US dollars, whether we're talking about gold or Bitcoin or any of the other assets priced in dollars. This has ramifications. Or if you trade currencies or EM, there's a lot of things that affect or a lot of different assets that you could trade that are affected by the short dollar trade. Now, some investors are concerned that the Georgia runoff elections, if we do have a Democratic sweep, then we're likely going to see a larger fiscal response and a sell-off here in the US dollar. I think some of those concerns are a little overinflated in my opinion, because on the back of that, the Democrats also plan on raising taxes, which will pay for some of the increases in the budget. So those are arguments, in my opinion, are not entirely true, in my opinion. So those are some of the things that I think is worthwhile to pay attention to based on the outcome of this election, based on the Georgia runoff election. Now, speaking about assets priced in dollars, gold. Gold had a false breakout here in early November where it broke above this what looked like a consolidation range here. And this consolidation range is actually held a little longer beyond that November a breakout here that ended up being a false breakout here. But over the past couple of weeks, we started to see more of a sustained breakout here above this consolidation range. And yesterday was the first confirmation of that breakout here. So now I think we can target 195 here to the upside here for gold. This is likely going to be a bit of a slower grind higher here up to that 195 level, but I think we can confirm that breakout now. But if we look at the weekly chart here, we've had a pretty significant move here from this low 130s, or high 130s all the way up to 195. We've had this consolidation range here for multiple months, which again is healthy after a big move like we have seen here to the upside. And this really projects fairly well here to the upside here. This falls in line with the short dollar play of a breakout higher here for gold, potentially significantly higher, and perhaps following in the footsteps of what we have seen here for Bitcoin. Now, Bitcoin has moved substantially. Some of you may remember when I called Bitcoin, when it broke out above 13,000, I was looking for a breakout up to 20,000. And I talked about that if you broke out above 20,000, that puts Bitcoin substantially higher because of that major multi-year double top that was put in here. Now that we've had that move all the way up to that $34,000 range, I think that you're likely to see some consolidation here going forward. Because we've gone a little too far too fast, in my opinion, here for Bitcoin. Now, Bitcoin obviously trades on a lot of hype. There's not a lot of liquidity out there, so big orders move the market fairly substantially here in a market like Bitcoin. So this is one that I think that for many investors are paying attention to. If you're concerned about the continued decline in the dollar, Bitcoin is obviously one of the places that you might position for that, but short-term positioning, in my opinion, is a little stretched. We did get some consolidation yesterday all the way down to that 28,000 range. I think that you could see a little bit more pullback here before looking for opportunities to go higher for Bitcoin. Now, when we look at the sectors, we see some sectors continue to gather strength here or gain some strength, and we're starting to see some sectors lose some strength here. So I want to point out a few that are on my radar. XLF, number one, continues to march on higher here over the past couple of months as equity markets kind of slowly grind its way higher. XLF outperforming the S&P 500, just shy of that $31 high, all-time high that it's put in back in February. So our expectation, especially with inflation expectations now back at 2%, and we're gonna see the rate curve continue to steepen, especially if the economy continues to recover at the pace that we're starting to see, even though there's some slowdown in that. This is really one of the sectors that, from a fundamental perspective, makes sense for it to continue moving higher, as well as right now the technicals and the relative strength so far are aligning with that that strengthening view here for financials. The next one is healthcare. Healthcare, while not particularly strong here over the past couple of months, right now has managed to make a higher high on our higher lows, and is testing this 114 resistance level, a bit of a triple top here. And when you get higher lows going into a triangle like that, that suggests that you could get a breakout here to the upside. So if you look at both the momentum indicator on the daily and weekly chart, nowhere near overbought. So room here to the upside on both the daily and weekly chart. Money flow is fairly positive here, both on the weekly and daily chart, which just turned positive here in early December. So this is, again, giving us some clues that healthcare, even though has largely lagged behind the market since April, starting to see a little bit of strength here. And the question is whether it's going to continue, but it is on the verge of that triple top breakout, so worth paying attention to. And lastly, sectors that's losing some steam here is XLI. There's plenty of sectors losing steam. Utilities is losing steam, real estate is losing steam, but XLI, one of the strongest sectors we have seen off of the March lows here, which saw a lot of strength here also going into the Pfizer vaccine, Moderna vaccine news, has started to really lose some steam here over the past few weeks as equity markets pushed to new all-time highs here last week. XLI failed to make new highs. So as the equity markets were making new highs and this was making newer lower lows, this is a sector that is starting to lose some relative strength here. As you can see, money flow has not been particularly strong here for the month of November and December. So this points to a potential decline here for XLI, especially if we see some further weakness here from the equity markets. XLI may be rolling over a little quicker. So this is one to pay attention to here as you start to see some rotation in the sectors where you're seeing some strength, where you're losing some of that strength. And semiconductors, also one that we want to pay attention to, as semiconductors, one of the strongest sectors or segments of the market rather. Consolidating here between this 210, 220 level here, looking like it's about to break out here to the upside. We have some semiconductor names to pay attention to. The weekly chart is a little overbought, but when it's sustained overbought like this, it can stay overbought and continue to march on higher. The daily chart has some room here to grow to the upside. Both the daily and weekly money flow is positive here. So this leads us to believe that semiconductors can continue to be strong, specifically if you look for individual names. I like looking for individual names in this particular sector for more upside going into 2021. Now, shifting a little bit to the economic data. Again, I was talking about the fact that in the early days of the pandemic, when we're talking about April and especially the April corporate earnings, where some of the companies came out and talked about supply constraints, the inability to import goods. We're starting to see some of this creep up again in the manufacturing data. So supplier delivery has taken a big dive into the end of the year, similar to the dive that we saw here at the beginning of the pandemic. And this really comes down to one of the issues on the manufacturing economic data, which is input prices. So what we're starting to see from manufacturers is that the supply of goods that go into the manufacturing process have increased sharply here towards the end of 2020. This is a result of the more regional lockdowns that we have seen around the country, a shortage of truck drivers, a shortage of a lot of different things that have caused the manufacturing input prices to increase sharply here at the end of this year. So we're likely, in my opinion, starting to see in the next quarterly earnings, which is going to kick off here in about a couple of weeks, We might see some of the retailers and some of the consumer discretionary, consumer staples companies talk about, supply constraints again, something that we haven't heard in a couple of months here, or quite a few months here, as supply chain was largely back to normal, even though stretched a bit, but we're starting to see some strains on that supply chain here. So this is going to potentially have an impact on consumer discretionary, consumer staples going into Q1 and Q2. So important to pay attention to when you're investing in some of these names, to pay attention to those conference calls on earnings to see if companies are talking about supply constraints. I do remember one specific one, Best Buy, which is one that we have a position in. Best Buy talked about supply constraints at the beginning of the year, or the beginning of the pandemic here. So this is one that we're going to monitor fairly strongly to see if this has some effect, and whether it's time to take profits on that particular trade, or get out of that trade as a result of this. On the other hand, we also see some moves here on consumer confidence. We've seen a decline in consumer confidence at the end of the year. This really speaks to, in my opinion, the uptick that we've seen in unemployment claims as regional lockdowns has caused more services job losses, especially if you look at small businesses. Substantial decline in small business job growth here at the end of last year. This is starting to cause, again, more constraints on consumer confidence here, which is going to also impact consumer discretionary, consumer staple names. So consumer discretionary, consumer staples, two sectors that are, at the moment, consumer discretionary hanging on. Consumer discretionary was by far the strongest sector of the S&P 500 on the recovery of the pandemic. So far over the past couple of months, consumer discretionary has largely just kept on pace. Consumer staples have largely lagged behind. So the question is whether consumer discretionary will start to lag behind as well. So these are some of the things that are concerning to us, especially for investors in consumer discretionary sectors. So looking at opportunities here in the market, this really points us to some of the things that we've researched here on our last members only thematic investing webinar, where we talked about cybersecurity. We talked about specifically Fortinet, which took off after our webinar. Now, the thing is that if you missed out on that move, we've gotten a recent consolidation pullback here. And I think what we have an opportunity here for is a breakout here above this 150 level here. And the pullback that we've gotten over the past couple of weeks, in my opinion, is an opportunity to look for a long position here in another strong cybersecurity name, Fortinet. One of the smaller players compared to Cisco, but one of the high growth players in this particular space, especially in emerging markets. So in Asia Pacific region, Fortinet has a pretty large exposure, and those are regions of the market that we think are going to do very well post COVID-19. So this is really one of the cybersecurity stocks that is on my radar, and the pullback that we saw here yesterday, in my opinion, provides an opportunity to look for a long position here. The other one is a semiconductor name. So I talked about the fact that I like semiconductors, but I would prefer to pick individual names rather than betting on the whole industry. And NXPI is, interestingly enough, we are going to talk about NXPI both in the in our thematic investing this particular week on electric vehicles, because NXPI provides some of the chips for cars. That's actually a primary part of their business, is the electronic chips in autonomous vehicles and electric vehicles. So this is really at the intersection of both semiconductors, which is a strong sector, and electric vehicles, which is very hyped up at the moment. So opportunities here at the intersection. NXPI recently consolidating here for a bit of a period of time. Looks like it's starting to break out here to the upside. So NXPI consolidation breakout here, as you can see here, both on the daily and weekly chart, has a little bit more opportunity to grow here to the upside. And lastly, EA, Electronic Arts. I talked about Electronic Arts just a few weeks ago on Options Action. We've had a major move here to the upside since then. We've likely, have consolidated a little bit here over the past couple of weeks, and again, near the bottom of that range here. So given the current market environment that we're in, the fact that we're starting to see the UK go back into lockdowns, Japan is trying to go back into lockdown, even countries that have largely, what we consider having COVID under control is going back into lockdowns and moving in that particular direction. from my perspective, the vaccine delivery, when we have less than 1% of the population having being vaccinated so far, this leads me to believe that we're likely going to see this working from home, streaming, especially in the colder months, continue to be a valid trade here. So EA at the forefront of that particular theme of lockdown stocks, but there's a big range in this particular category. Everything from Zoom to Disney Plus to Comcast. Any of these companies in the communication space are beneficiaries of what we consider lockdown stocks. And EA, given the relative strength that we've seen recently, given the weakness that we saw yesterday, I think provides an opportunity to look for a long position here in a lockdown stock like EA. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how to set up here for the broader markets and the equity markets for this year. As again, we're starting off on a fairly jittery footing here. So for many investors, it's important to understand, how to position yourself going into what is a rockier start into 2021. So with that, I want to thank our members for supporting us and allowing us to continue to put out this type of content every single week. I'm looking forward to doing the thematic investing series this Friday, which is again available only to members on electric vehicles. A lot of you have been asking us a lot of questions about electric vehicles, so I wanted to make sure that we spent the time to cover that. The theme of January is really renewable energy. We're going to be talking about electric vehicles this Friday. And the third Friday, we're going to be talking about renewable energy. We're going to talk about solar. We're going to talk about hydrogen. We're going to talk about batteries, specifically around the industry and specifically around the companies that service each one of these categories. So if you're not a member yet, you can sign up using the link that's on your screen or in the chat window here. This will give you a better understanding as to how to utilize the OptionsPlay tools and get that ready for the session here this Friday so that you are coming prepared to that session so you can maximize your value for your membership. And if you don't have an OptionsPlay account yet, you can sign up for a free 30-day trial at optionsplay.com. Really looking forward to seeing many of you here this Thursday on the options education session and the thematic investing session this Friday. So I have 2 minutes here for some questions here. If anyone has a question here, Jamil is asking, how should we think about the 21-day moving average as it relates to our buy and sell decisions? How much weight do you give to historical pricing? So, Jamie asked a good question. How important is the 21-day moving average? So I would say the 21-day moving average for me is fairly important from a timing perspective. So I generally have a list of stocks that I like from both a technical relative strength perspective as well as from a fundamental perspective. But just because I like the fundamentals of a stock does not mean that I should buy the stock at the time that I do the research, because the reality of it is that you will have far better opportunities to make gains to the upside when you buy near or below the 21-day moving average than if you buy above the 21-day moving average. So, the 21-day moving average is the average price over the last month here. It provides different tools. It provides a timing tool. It also provides an idea as far as the velocity, if you will, of how a stock is currently moving. So when the slope of the 21-day moving average is extremely steep, that's usually telling me that there's a lot of potential hype behind that particular move here. Usually I don't like a lot of hype. I like to wait for a pullback here after a hype move in order to get into that. So it is fairly important, but it is used in many different ways. Thoughts on Lululemon? I haven't looked at Lululemon in a few days here. Lululemon has really started to, I would say perform on par with the markets here. So it's a slow grind here to the upside. The athletic wear, continues to be fairly strong. Nike does fairly well. Lululemon's been doing fairly well at their e-commerce strategy. So I think Lululemon will continue to move higher here, but I don't think it is my favorite stock. I think out of that particular category, Nike is probably a better stock. Even Peloton, I like more than Lululemon. So Lululemon, strong, but not, in my opinion, very strong. So with that covers what I wanted to share with you here today. I hope that you guys have a great trading day. Looks like market's just about to open up here, pretty much flat from yesterday. So again, just below that 21-day moving average, potentially an opportunity to look for some long positions, specifically in some strong stocks that you like. So with that, thank you so much. We'll send out the recording to this as soon as we're done processing it, and we'll see you guys here on Thursday for our Thursday afternoon options education session. Thank you so much and have a great trading day.